Hi everyone. Well, in follow-up to last week's video where I focused in a little bit about what's happening with the economy and the yield curve and interest rates, I got a lot of feedback and I wanted to drill in a little bit more into what's happening. The inverted yield curve is getting a lot of play in the media right now. We have the 10-year versus 3-month Treasury rates inverted with higher interest rates on the 3-month Treasury. So it's getting a little bit more momentum in the media, which in and of itself can affect confidence levels and in turn potentially even drive a recession itself. Short-term bonds like the 3-month Treasury are very heavily influenced by short-term lending policy, by banks, and by what the Federal Reserve does. And the Fed's been putting a lot of pressure on interest rates, short-term interest rates, over the last couple years. They backed off recently, but it still has that momentum carrying through. Whereas the 10-year Treasury is much more affected by what's happening in the stock market and what's happening in foreign interest rates as well. But again, even though there's an inverted yield curve right now, a recession is not a foregone conclusion. There have been 2 false positives where the yield curve inverted and it was not followed by a recession. And what's driving the inversion matters. Right now we have a trade war going on that's driving uncertainty on Wall Street, and it's pushing capital out of stocks and into bonds. That's pushing down those long-term rates. Now, until recently, the Fed was pushing those short-term rates, so that pushed those short-term rates right up into the long-term rates, and that sparked that inversion. Now, there's a lot of other important considerations. The economy is adding jobs at a very steady pace. It's been averaging almost 220,000 jobs per month for the last year. There's a record 1.7 million more job openings today than there are people looking for work. Per capita disposable income, inflation adjusted, is at an all-time high, and it's about 12% higher than the prior peak set in 2008. Overall, households have a much stronger balance sheet than they did in the prior cycle, with less debt, higher savings, and more income. So there's a lot of factors driving stability in the economy right now and even growth. So what's all this mean for commercial real estate? Well, increasing caution is weighing on investor decision making, which makes now an opportune time for investors to consider their portfolio and diversification. They should be looking at recession-resistant assets, things like workforce housing, particularly Class B properties, self-storage properties, credit-backed single-tenant retail assets, infill industrial fulfillment properties, and medical office. All have a tendency to be a little bit more resistant to recessions because mostly they're necessities based, or they meet certain needs that happen during recessions. And remember, the silver lining in all of this activity right now is that long-term interest rates have dropped. They're now at their lowest level since October 2016. That's more than 2.5 years ago. That makes this an opportune time to buy and refinance real estate. It's also a very good time to prune any assets that investors don't want to hold through the next cycle. Capitalize on this window of opportunity to lock in low interest rates through either purchases or through refinancing of assets.